In this part of the course, we're going to talk about cryptocurrency futures and leverage trading, which is quite a broad subject, but we'll go through some basics about it first. We'll go through some pros and cons, and then we'll have a look at the charts and show you how exactly you can trade cryptocurrency futures. And for this example, we'll use Binance and we'll also use the Bitcoin pairing. So, currencies are digital coins. We all know that. But within these, there's options to do futures contracts trading. A futures contract is an obligation to buy and sell an asset at some date in the future. Futures contracts are often used by commercials looking to hedge their exposure and speculators looking to generate a return using leveraged securities. A futures contract can be financially settled, meaning that you are only responsible for your financial gains or losses. There are also physical settled futures contracts requiring one party to deliver money and the other party to deliver the underlying asset. Most widely traded cryptocurrency futures contract is a Bitcoin futures contract traded on the Chicago Mercantile Exchange, which is CME. If you're ever looking on Twitter or on anywhere and people saying, look, we need to close that CME gap, that's what it is, a Chicago Mercantile Exchange. Bitcoin futures contracts traded on CME are financially settled futures contracts. But going more into it, you can use margin on these contracts too. One of the benefits of trading Bitcoin futures contracts is that futures provide leverage. This is made possible with borrowed capital. Each broker can have a different margin requirement as long as it is above the exchange requirement. Bitcoin futures contracts are volatile, and therefore the leverage levels can be quite conservative. For example, in 2019, the CME provided leverage on a Bitcoin futures of 2.6 to 1. This means that your profits and losses will both be enhanced as you're controlling more value than the cash have posted in your margins account. This type of leverage might be considered conservative, but rules of exchange and volatility of Bitcoin reduce the leverage that the exchange provides. We do know that on here, Binance lets you change your leverage amount up to a huge amount of 125x, so just be aware of that. High leverage is not always the best thing to do, but it does offer you that capabilities. So going through some pros and cons. So there are many benefits and a few drawbacks to trading these futures contracts. Futures prices track the underlying movement of Bitcoin, removing the need to open your digital wallet account. Futures allow you to hedge your Bitcoin exposure at some date in the future. Futures provide you with leverage through a margin account. Futures are liquid, allowing you to easily enter and exit your positions. And Bitcoin futures on CME are regulated by the Commodity Futures Trading Commission. Going into some cons though, you can't use futures contracts to pay for goods and services in the way you can with Bitcoin held in a digital wallet. The margin requirement for one futures contract can be sizable for retail traders. Futures contracts also have a termination date, so that trade could be stopped out at some point in the future. And the futures contracts are liquid when the exchange is open. So just be aware of that at some stage, if we did get a market dump, that could completely blast through your stop loss or your liquidation zone. So that's all the basics about leverage trading, what it actually is, what are contracts, and a few pros and cons. But looking at the chart here, we'll talk about the layout of the user interface here first using Binance. This is very similar on different exchanges, for example, Bybit, OKX, Bitfum. They're all very similar. The actions you do are quite similar too. So as you can see, we have a chart in the center here. You can switch it between the original Binance chart or the TradingView chart. Personally, I use the TradingView chart, and you here switch between any time frame, and then at the top here, you can search through all the perpetual contracts. Perpetual contracts is the one that you are pretty much you are going to be using because they are all USDT pairings. Whenever you are trading here, you're not actually trading Bitcoin, but you will be using USDT. There's an option you can switch to using the coin itself and leveraging, for example, Bitcoin, but I advise not to do that because that is quite advanced. On the right hand side here, we have the orders that are currently going through. We have a sell book here and the buy book here, so that is the order books there. There's not too much you need to really know in terms of how you do it, but there's several options here. You have isolated and cross. Personally, I always stick to isolated. That means that your leverage does not swing in and out of position. So click that, make sure it's confirmed. And then to the right hand side of that, you have the leverage. If you are new to cryptocurrency leverage trading, I will never have it any higher than 5 personally. So you can push it up to whatever you want there. Move it down, we'll put 5. You can put that all the way up to 125 XO, but your liquidation zone whenever you open a trade at 125x would be so close to your buying price, it would pretty much get wicked out straight away. So you need to be, even anything over 10x, you need to be highly confident, in my opinion. So yeah, once you've done that, click confirm. This then locks in your amount of leverage. Just beware of it, when you switch through different assets, that leverage will change. So every time you open a trade, make sure that you check the leverage. I've done it so many times when I was opening a trade and it's been on randomly on 50x and the trade's been liquidated. So just be wary of that. So now you have Bitcoin USDT, isolated, 5x leverage. You then go down to this section here. So we have limit, which is what you pretty much mostly want to set a trade up with. Market, if you just click there, for example, drag this cursor up and down, this will drag up and down the amount that's in your current balance. So for example, down here we have $47. If you put 100% of your allocation on there, buy long, that will give you a market buy price at this current price here at 5 times leverage, and then it's way out. Clicking on limit though, this is the best one to use. So for example, we're looking at a price now and we have identified, let's just put a box on here. We've identified this level here. We want to put a buyer order just in there. So that's at 46764. What you do, you type that in here. So 46754. That is an area you've identified with your own technical analysis that you want to buy in. You then put the amount in Bitcoin or USDT, mostly click USDT. Make sure that's changed. Then move it up. For example, you can do it by this or whatever you want, but personally, I would do that there. So I would put, for example, we'll click there, that's 27%, that is $46. That is only actually $9, but that's already times by 5 leverage, so it shows you the max amount there that's available, but this is how much is going to go on. So we're going to be putting $46, which is $9 times 5 leverage. So that will give you the amount. You then click buy. So let's do that for now. Let's click buy. What it will do is then it will open you here. If you click on the bottom section, open orders. Your order is now in place and you are waiting for the price to come down and pick that order up. Just be aware of it when you're setting a limit order on a buying opportunity, which would be a long position, you are buying, setting the order below the current price, waiting for it to come in. Once it comes down, it will then pick your order up. And the opposite with a short position. So a short position is a sell. Whenever you're looking for a sell, you will put the price higher than the current price is now. So we're now waiting for this price action to come down and activate a trade. This will not happen instantly. I mean, we could have set it down at this level in case we got a wick down there. It's totally up to you and totally up to your own personal technical analysis. Once this trade is open, it will go to this section here, positions. Then you'll be able to set your stop loss. A stop loss is basically a safety blanket. So for example, you open trade here, you don't want to set it too tight, for example there, because it would just completely close your trade down, but you'd look in potentially a 5 to 10% stop loss, so that will be around this area here. And then exactly the same happens on a short position. Go into a section here, make sure it's on limit, and then go to this side here and then set up a trade. We'll cancel that order now because we don't want that to activate. But that just shows you how to open a long position, and the exact same for a short position. If we're looking for, we'll do it now for a short. If you're looking at the price now and you think, right, when the price jumps back up to here, which could be a key area of resistance, I want to open a short. So that'll be 47912. So we'll type that in this box here. 47912. What you'll do then is type the amount of USDT you want. We'll do 25% again. That will be $19. But times by 5 leverage. Remember to check your leverage every single time. And that will be equivalent to $95. Click sell short. Then once the price does come up to that level, it will set a sell up order, and that is your short then activated. So that's how you set up a long and a short position. When the trade becomes active, you will get given a stop loss position here. All you have to do is set another sell order or buy order above or below the price that you entered in order to make sure that your trade is safe and it's not going to get completely liquidated. Liquidated means you have no stop loss in, and for example, you have a long position but the price tanks down maybe 50%. Depending on your leverage, that trade could be wiped out within seconds. The lower leverage, the lower chance of a wipeout, but the more you start pushing that leverage up, there's a real high risk that your trade could be liquidated with a spike up or a spike down.